you think you need perfect credit in order to buy a house, that myth may be costing you years of home ownership. Listen, the truth is thousands of people are getting approved for mortgages with scores far lower than you expect. In this video, I'm breaking down the real credit score requirements for buying a home, the biggest myths that can scare buyers away, and what lenders actually look at when approving you for a mortgage. You guys, I'm Joubert Caston, local real estate advisor in the area, but most importantly, a very proud girl dad. By the end of this video, you're gonna know exactly what your credit score really means for buying a home. And reach out at any point. My contacts are in the description below. Would love to offer you a free, no obligation consultation call and a strategy call in order to make your next move your best move. So let's dive into myth number one. You need perfect credit or excellent credit in order to buy a house. That's the biggest myth right out the gate. The idea that you need a very good score, typically 740 plus, or even a perfect 850 to buy a home, that's just flat out wrong. While a sky high score will definitely land you the best possible interest rates, it is absolutely not a requirement for getting approved. The reality is that different loan programs are built for people all across the credit spectrum. Lenders don't just fixate on the 3-digit number, they look at your entire financial picture. They're interested in your income, your job stability, and how you manage your debt. Your score is just one piece of the puzzle, not the whole game. So what are the real numbers? For a conventional loan, the most common type of mortgage, the minimal credit score most lenders look out for is around 620. You guys, listen to me. That's 620, not 780. And it gets even better than that. For an FHA loan, which is insured by the Federal Housing Administration and a huge favorite among first-time home buyers, the minimum is even lower than that. With an FHA loan, you could potentially get approved with a credit score as low as 580 and only a 3.5% down payment. If you can make a 10% down payment, some lenders will approve a score as low as 500. Usually I see it a little bit higher than that for sure, but there's ways to work around certain things when it comes to FHA. And for our veterans and active duty military, VA loans are often even more flexible. While the VA itself doesn't set a score minimum, most lenders look for a score somewhere between 580 and 620. So let's bust this myth for good. Homeownership is not some exclusive club for the 740 and up crowd. It's literally the home of where there's a will, there's a way. So myth number two, you must be completely debt-free. The next huge misconception is that you need to be totally debt-free before a bank will even glance at your mortgage application. This makes so many people put off their home buying plans, thinking they need to spend years paying off every last cent of their student loans or car payment. I can't begin to tell you enough. I do a lot of buyer consultations, and people literally fear the fact that someone's going to be looking at their credit report because of the debt that they have, which usually scares them away from home ownership. That can't be any more of a myth. People who work in the mortgage world are here to help you, are here to structure a plan based around what you're dealing with. So lenders expect you to have some debt indeed. In this day and age, it's completely normal, and most of us have car loans, student debt, or credit card balances. Honestly, having and managing debt responsibly is how you build a credit history in the first place. What lenders really care about isn't the debt itself, but your ability to handle it alongside a new mortgage payment. They measure this with something called your debt to income ratio, or DTI. This is just a percentage of your gross monthly income that goes toward your monthly debt payments. As a general rule, lenders like to see a DTI of 43% or lower, but many loan programs can be more flexible. Think of it this way. A lender is far more comfortable with someone who has a $30,000 student loan and a stable job making on-time payment for years than they are with someone who has zero debt but also no credit history and a shaky income. Smart debt management actually proves you're a reliable borrower, so stop waiting to be debt-free. Focus on managing what you owe and keeping your DTI in a healthy range. Listen, we're about to bust a few more myths that might be holding you back. But first, if you're finding this helpful and starting to feel more hopeful about buying a home, do me a favor. Hit that like and subscribe button. Use my contacts in the description below to book your free no obligation strategy call, and let's make homeownership real for you. Now into myth number three. Closing old accounts boosts your score. Now check this out, guys. This next one sounds logical, but it's a trap. The myth is that closing old, unused credit card accounts will help your score. It seems to make sense, doesn't it? You're just clearing up credit report. In reality, this is one of the worst things you can do right before you apply for a mortgage. Closing old accounts can actually hurt your credit scores in two big ways. First, it shortens the average age of your credit history. The length of your credit history is a big part of your score. A long history shows lenders you have a proven track record. When you close your oldest account, you shrink that track record, which can make your score dip. Second, it raises your credit utilization ratio, another huge factor. This ratio is simply the amount of credit you're using compared to your total available credit. Let's say you have a $1,000 balance on a card with a $10,000 limit. Your utilization is 10%. But if you close another unused card that also had a $10,000 limit, your total available credit just dropped. Now that same $1,000 balance represents a much higher utilization, which can make you look riskier to lenders and lower your score. This all sounds so weird, doesn't it? If you close something, you actually get penalized as compared to rewarded. So the rule of thumb is simple. Keep those old no annual fee credit cards open, even if you only use them for small purchases once or twice a year, just to keep them active. That long history is pure gold for your score. Myth number 4, you shouldn't use credit cards at all. This myth is a close cousin to the last one. It's the idea that the safest path is just to avoid credit cards entirely. This thinking goes, if you don't use credit, you can't get into trouble. While the intention is good for sure, this leads to what lenders call a thin file. If you have no recent credit activity, lenders have no way of knowing if you're a responsible borrower. No activity means no score, or a score too weak to be taken seriously. A lender would much rather see a history of you borrowing and paying back successfully than no history at all. Doesn't this all sound strange? The key is not to avoid credit, but to use it as a tool. The strategy is simple. Use your credit card for a few small planned purchases each month, like gas or Netflix, and pay the balance off in full before the due date. This way you pay zero interest, but get all the credit building benefits. You're proving to the credit bureaus and lenders that you are reliable, low risk, and can handle credit responsibly. That consistent positive payment history is the single most powerful factor in building a strong score. Myth number 5, shopping for a mortgage will wreck your score. Now this is a big one, guys, and it costs people a fortune. So many home buyers are terrified to shop for the best mortgage rate because they think every time a lender pulls their credit, their score takes a huge hit. Now let's clear this up. There are two kinds of credit inquiry, soft and hard. A soft inquiry is when you check your own credit or when a company pre-approves you for an offer. Softer inquiries have zero impact on your credit score. A hard inquiry happens when you actually apply for credit, like a mortgage. A single hard inquiry might cause a small temporary dip in your score, usually just a few points. But here's the crucial part everyone misses. Modern credit scoring models are smart. They know you're going to shop around for the best deal on a big purchase. Because of this, all mortgage-related inquiries that happen within a specific time frame, usually 14 to 45 days, are grouped together and treated as a single inquiry for scoring purposes. This means you can and absolutely should talk to multiple lenders to compare rates and fees without worrying about your credit getting hammered. Saving thousands of dollars on the biggest purchase of your life is way more important than a tiny temporary dip in your credit score. So, what lenders actually care about? Now that we busted the myth, let's recap the facts so you have a clear picture. Forget the idea of a perfect score. Here are the numbers that actually matter. FHA loans. Fantastic for many buyers. You can often qualify with a credit score of 580 and a 3.5% down payment. Conventional loans. The most common mortgages. The typical minimum credit score is 620. If you're above 620, you're in the game. VA and USDA loans. For our vets and for buyers in designated rural areas, lenders often look for scores in the 620 to 640 range. And these loans often offer incredible benefits like zero down payment options. But more important than any single number is the story of that your financial habits tell. Lenders prioritize consistent on-time payments above everything else. They want to see stable employment and reliable income. They look at your credit utilization, making sure you aren't maxed out, and they analyze your debt-to-income ratio to be sure you could comfortably afford the new house payment. A person with a 640 score but a long history of on-time payments and a low DTI and money saved is often a much better candidate than someone with a 720 who is stretched thin, has a spotty payment history, and no savings. Your credit score opens the door for you, but overall, your financial health gets you the keys. You guys, if owning a home is a dream of yours, you are closer than you think. Reach out today. When it comes to the credit and the mortgage side, I have specialists who can help you today. Use all of my information in the description down below. Reach out and book your free no obligation strategy call with me today. Let's make your next move your best move. I guarantee you are closer than you think. I've helped so many buyers realize this who have came to me off platforms like TikTok, Instagram, who think that they are so far away. After talking to certain professionals, they realize that they are closer than they think, or worst case scenario, they actually get some darn keys, y'all. Use my information in the description below, and I look forward to talking to you. Take care of yourself. Have a blessed day.